think they're trying to talk a tough game to make sure that inflation.
A 2-year recession. So
crypto and gold and soft commodities, kind of the only things.
The Federal Reserve could get the economy in a very deep recession, one where it may not be able to get out of. That is the opinion of Gareth Soloway. Do you think he is correct? David Rosenberg explains why he believes we could be entering a recession that could last upwards of 2 years. And Dan Morehead has a very positive outlook on crypto. This is the state of crypto today. Subscribe for more great content. And as always, hit the like button.
So it's a weird time right now because you're coming off of the COVID lockdowns and stuff like that, and then obviously there was the surge and then kind of the reflex retraction there. So I think it's one of the most hard times to really figure out what is a recession, what isn't. For me, what I'm going to look at is I'm going to look at the jobs numbers. You start to see a significant uptick in unemployment. We did see a tiny uptick in unemployment last Friday, but it was mostly due to people coming back to the workforce. I think that over the next few months, you're going to see that unemployment rise to 4%, a little bit above. And then once we see the GDP numbers remain weak plus that, then it's like, okay, this is a no-brainer official recession that you could call it that at that point.
Mm-hmm. So do we see the Fed or do you see the Fed kind of backing away from further rate hikes towards the end of this year?
I do. I really do. I mean, I have it penciled in for a 50 basis point at the end of September hike. So again, for me, now there's a lot of talk and the markets are even saying it could be 75 basis points. I'm thinking the Fed is, at least I hope they're smart enough to understand that they can't, and it's very dangerous to continue aggressively hiking rates. Because again, each rate hike takes a certain amount of time to work its way through the economy, right? Mm-hmm. So if you hike 3 times in a row, 75 basis points, and then all of a sudden in 6 months, we're in a deep recession, ask yourself, how do we get out of that recession? Because every past recession, the Fed has come to the market's rescue. QE, QE1, QE2, QE2. And I mean, you just went on and on all the way through COVID with printing money and lowering rates. And so the Fed can't do that anymore with inflation as high as it is. So I really hope they're careful. I think that they're starting to see those signs of weakness creeping in like they want, the inflation numbers coming down. And I think that that would be the goal here, to start that. They can always do 50 again later in the year if they want to, but starting to just bring it down a notch would be a very confidence boosting thing for the economy and for the markets.
So is that going to be, let's say for risk assets, is that going to be basically seen as a Fed pivot? This maybe the smart money trying to get back into risk assets as the Fed eases off that tightening policy that they have?
That's what I think. I think in the near term, that's going to be kind of like a breath of a sigh of relief, if you will, where they're on their downward shift. Now they may still do another 50 at the next meeting, maybe 25, whatever it is, but they're starting to kind of come down the mountaintop, this way at that point. And I think in the near term, that is a positive for risk assets. My thinking of, and why I'm net longer term bearish, is that I do see us going into a recession, even if they start kind of coming down on the hikes less and less, we're still headed into a full-fledged recession. And again, I think once the market realizes the Fed can't bail us out of this recession, the market's going to freak out. It's going to say, okay, this could be a long, drawn-out recession, making up for all the lack of recessions that we've seen over the past 10 plus years. And that could be this kind of stagflationary kind of period in the markets. And I think that's the culprit for the next big leg down that takes us down to the pre-COVID low highs from 2020 and even below.
Mm-hmm. Your thoughts are now where we are, first bigger picture, and then we'll zoom into exactly where we are in the cycle.
Well, we are in the early stages of what is probably going to be a 2-year recession. So that's where I think we are right now. And the beauty about this call is that it is separates itself from the consensus view that we're going to experience a soft landing or a short and shallow recession. It could be shallow. It's not going to be short. That's where we are.
So I'm actually come from a different perspective. I thought it's going to be sharper and shorter. Where's the length come from? Is it the length of the bear market potentially as earnings come down, or the recession itself. Talk me through that framework, how you've come to, because you're the first person who's really talking about a long recession.
Mm.
Where does that come from in your framework?
Well, it really comes from what the catalyst is going to have to be to get us out of the recession, which is, it looks like it started even earlier than I thought. I'll just say at the outset that although back-to-back negative quarters of GDP isn't the technical official NBER defined recession, it's a Wall Street rule of thumb because it always works. Whenever you've had back-to-back negative quarters, you've been in recession. Whenever you've had 2 quarters down out of 3, you've been in recession 100% of the time. So that's where we are. There's really no doubting it unless you want to attack the historical record. But you see, the reason why I think it's going to be long is because it's already started. And so has the Fed tightening cycle, just started in March. And the peak impact on the economy from whatever the Fed does, whether it's easing or whether it's tightening, there's lags involved because the economy ongoingly resets to a different interest rate regime. The lags are generally about 12 months. And the Fed only started raising rates in March, and they've gone a long way. They've gone 225 basis points. And even once they pause, they're still going to be undertaking balance sheet reductions. So they'll still be tightening policy even after they move to the sidelines in interest rates.
Let's talk crypto as well now. So how does this macro framework, which sounds like either inflationary or a certain amount of monetary tightness that we're not used to, how does that work in the crypto market? How does that flow through?
Yeah. So when the Fed and the Congress started printing just, insane amounts of money, I will admit I had my pom-poms and I was like, this is awesome for Bitcoin. You got to own Bitcoin. And, Bitcoin's at 3,000 or whatever at the time, to 60,000. So huge fan of that story. So some people say, well, it's totally counterintuitive. If they're going the other way now, that's going to be horrible for crypto. And I really, although admittedly I was hugely positive on Bitcoin because they were printing tons of money, they've already printed all that money. It's out there, right? There's 9 trillion of bonds that have been printed and out there. And that money's not going away, probably, right? Like, I don't think they're going to sell all those bonds and take all that money out of the system. I actually think they should, but I just don't think they will. So all the money's already out there. So it will still keep sloshing around and generating inflation. And there's this huge debate right now, is Bitcoin really a good inflation hedge or not? We don't know because we haven't had inflation for 15 years, right? We're going to find out. I actually think we're going to find out it is a great inflation hedge, that when people are worried about the currency being debased 10% a year, they'll start looking for alternatives. And that used to be countries like Argentina or Venezuela or whatever. Now it's going to be American citizens. It's going to be British citizens. It's going to be Europeans. All are going to be looking for ways to get protected on the debasement of their currency. And although recently crypto has been highly correlated with risk assets like the S&P, I'm betting that it's going to break down, that there are going to be more people going, if rates do keep rising for the next 2 or 3 years, I don't want to own bonds, definitely. Probably don't want to own stocks. The Fed really has to get real estate to go down before inflation stops. So I got to get out of real estate. Crypto and gold and soft commodities, kind of the only things left, or art, maybe, intellectual property. There's a few things that are kind of different from rates, but not many. And so I think, crypto being one of the biggest and most interesting will start to get the marginal dollar being allocated to crypto.